Welcome back, guys. So it's happening again. The market is bleeding again. Monday seemed like we got a little bit of a break from last week's sell-off, but yesterday and today again the markets are just heading back down, and today was pretty bad. We've got the Nasdaq down around 2.7%, the S&P 1.31%, the Dow less affected but still down at 0.39%, and we've got the VIX up around 10%. So again, like we were doing last week, we'll talk a little bit about why this is happening, what you should be doing, and mainly I think I'll talk a little bit about what kind of stocks maybe you should be avoiding at this moment in time. So if you're looking forward to it, if you're interested, make sure you do stick around. As always, I hope you guys are gonna like this one. So last week we had a lot of that selling off with bond yields basically rising. So what's happening today, you can see here on Yahoo Finance saying stocks dipped on Wednesday, extending the losses which they had on Tuesday as investors weighed optimism about widespread post-pandemic business reopenings, the strength of the economy, basically against the concerns about the economy getting too heated. So all this again is coming back to inflation, rising rates and rising interest rates. So what happened today is basically the treasury yields, which a lot of people thought were kind of ready to take a breather, take a pause, carried on advancing again across the curve, and now the yield basically closed at around 1.5%. So the yields were going up rapidly last week, and that was contributing to that huge sell-off. Then it's kind of been taking a breather, and people thought, okay, maybe we're going to get a little bit of a break, but yields have started on a march again, and obviously that's caused another sell-off today. In addition to all of that, there was a disappointing report about private payroll growth for February. So what that basically means is private companies are basically adding less people to their payrolls than economists projected. All of this is quite contradictory because stocks you expect to go up when people expect the economy to do well, but people think the economy is going to do so well that inflation is going to come, that interest rates are going to rise, and that valuations, especially of highly valued stocks, are going to get punished for it. So this is why you're seeing a large sell-off, it is quite broad across, but largely concentrated to a lot of the more highly valued stocks. So with all of this happening, a lot of people are probably just wondering what they should be doing. Well, the first thing you shouldn't do is panic sell anything, because when you sell when stocks are down, you're basically selling what you own possibly cheaper than what it's worth. And that's why it's really important to have conviction in the stocks you invested in, to know where you expect them to be a couple of years out from now, so that when times like this come, you can hold on to them. And if your stocks are at good prices and better prices than they were yesterday, you can also add some money into them. So for example, you might have a stock such as Etsy up at $244, well beyond what I think is a fair price to pay for it. And then it comes back down to around 200 and looks a lot more palatable to buy. So you've got to turn these times to your advantage. Realistically, it is these times where money is made. To exemplify that, I just wanted to show you, for example, again, this is just a random stock I picked out. If you look at Facebook stock, so if you were to buy this stock in 2018, kind of at this peak where it's been running up for a few years, and at a time where the market peaked quite a lot in 2018, then now in 2021, almost 3 years later, your return is 21.6%. Now most people probably wouldn't be most pleased with having a stock only move up around 23% if you've been holding it for more than 2 years, especially when you're purchasing a growth stock like Facebook was once upon a time. Now what you see here is really different, is if you don't buy at these peaks when the market is really excited. The market was really excited in 2018, and then towards the end of 2018 the market took a big tumble after the real estate market took a tumble. And let's say the market comes down in 2019, people are a little bit scared, money is leaving the market, stocks are coming down, and you buy the stock here in 2019. You see now, within a lesser space of time, you'll actually have around 104% return. Now to get that in around a year and a bit is absolutely phenomenal in any case scenario. So this is where I'm just trying to stress that it can be easy to get caught up in buying stocks while they're running up, but the real money is made buying stocks when they're crashing down, when people are scared, people have lost faith in these stocks, people aren't sure that these stocks are going to keep going up. and these stocks come crashing down below what is a good fair price for them, is the time where real money is made. It's the difference between making around 20% and having the opportunity to make around 100%. So I'm always reminded of something that Peter Lynch said, and what he said was the worst thing that can happen is you buy a stock at a peak like this, and the company goes on to do amazing things. The company is successful, the whole story is successful, but you as an investor are never successful because you bought the stock at a peak, and therefore the price just never really had anywhere to go, even though the company went on to do amazing things. So don't be scared of the times when the market falls like this. Just be more confident of the stocks you're investing in. Only invest into companies you've thoroughly researched, you thoroughly understand, and you thoroughly believe are going to go on to do amazing things. Now, you're unlikely to be right all of the time, but you only need to be right around 5 to 6 times out of 10 to be really successful as an investor. So don't get too caught up, don't get too worried. Just invest in stocks you believe in and take advantage of these downturns in the market. Like I keep saying, this is where the money is made. Now, just to quickly show you guys another example, there's so many examples of these kind of situations. But again, another stock is Amazon. If you bought this at the peak of the market in 2018, today you're up around 56%. But if you didn't get scared when the market came down in 2019 or at the end of 2018, within around a little bit above a year, you're up 118%. So as I keep saying, these downturns in the markets are where the money is made, but it's all about making sure you invest into good companies. Now, does that mean that there's no single stock in your portfolio that you should consider selling? I wouldn't say that. It all depends on your conviction and where you expect these stocks to go. But if you're thinking maybe there's stocks in my portfolio which I kind of got roped into buying in hype, and maybe these stocks are really, really, really highly valued, and maybe these are not the best stocks to hold on to, then maybe stocks like that you could possibly consider taking a profit on. Now, you guys know normally I'm a very long-term orientated investor, but we all make mistakes, and if we invest into stocks and later realize that maybe this wasn't the best investment, then there's no shame in selling those stocks either. So just to talk about a little bit about what's kind of been going on in the market and the kind of companies that you wouldn't be a surprise to see suffer. So you've got companies like this, such as Appian, which is a tech company. Now, the company is really, really exciting and in a really exciting field. However, with expected revenues in 2021 of 335, the stock is currently priced at 35 times its sales. There's no PE on the stock because the stock's unprofitable. That in alone of itself isn't necessarily an issue. A lot of exciting companies are not profitable. But it's not normal to see companies priced at prices like 35 times sales. Then you've got companies such as Shopify, again a company that I absolutely love, but with a forward PE of 300. Now, it's usual for growth companies to have PEs somewhere maybe 40, 50, 60 even. Amazon has regularly been priced around 75, 90, but 300 is really, really, really high. And on a price to sales ratio, again, Shopify is priced at 36 times its estimated 2021 sales. And another company here which you've got is Neo. Neo has a forward PE for 2022 of 710, more acceptable in Neo's case because it's just about becoming profitable. But again, in 2025, priced at 68 times forward PE. Now, before the correction, before it lost around $20, that was even higher, closer to around 80 for the PE expected 5 years from now. But it's these kind of stocks that were always going to be the ones likely to get hit if there was a correction. So it's not a surprise that Neo has seen a 10, 15, 20% drop in the last couple of weeks, because like I said previously, it was priced at around 80 or 90 times its estimated 2025 PE. But that's what's happening in the market at the moment, what's been happening, and why I've been cautious for a really long time with certain kinds of companies and companies that were valued in certain ways, because it was always likely that there was going to be a kind of valuation reset. So the kind of correction you're seeing in the market right now is a little bit more worrying to me than the kind of crash you saw in March, because with that kind of crash you understand that there was problems in the economy and that's why the market's coming down. But the thing with this kind of correction is the fact that it's a lot more orientated to valuation. There's nothing that investors are necessarily scared of. There's no fears necessarily that the economy is going to the pot. It's the fact that people think interest rates are likely to rise, and a lot of these stocks are just too highly valued, and we need to basically reset our valuations. And that's a little bit more scary because now it's getting more difficult to project 5 years from now what kind of valuation stocks may hold. And that's why these kind of stocks are really risky, because it's not normal for a company such as NEO to trade at 80 times estimated earnings for 5 years from now. Now I'll show you an example of where a company with a high PE isn't necessarily a problem. So you see, if you look at a company such as Etsy, it does have a high PE at around 61, much lower than some of the other things we've seen, but still a relatively high PE. However, by 2025, with the kind of estimated analyst earnings for the company has a forward PE of around 23. Again, it's still a little bit high, but you can look at this and say reasonably that okay, a company growing like Etsy can reasonably be priced at around 40 PE in 2025, and therefore investing today I can reasonably assume to double my money. Coming back to a stock such as NEO, you look at this forward PE of 70 and you ask yourself, do I really think that NEO is going to be priced at 140 times its earnings in 2025? Because that's what I need in order to double my money in 5 years time. Now this is what I mean and what I said earlier about investing in companies when the prices are just way too high, and then the company, like I said, this is not a criticism of NEO, of Shopify, of Zoom. These companies are going to be very likely fabulous, amazing companies that go on to do amazing things, but if it's already priced in, then the stock doesn't necessarily have to move forward with the companies when they move forward. That's something that's really important to remember. Now, this is not me saying any of these companies are overvalued. You have to make your own decisions, because the only way that I could justify paying this price for NEO is if I say that analysts are completely wrong and NEO is going to earn way more than that, and therefore the forward PE is actually only around 25. And therefore, if I say NEO has a forward PE of 40 or 50, I can reasonably double my money in 2025. So if you think that, then that's absolutely fine. If you've got the research to back that up and you say, actually, this is wrong. So for example, in my case, you can see they estimate Li Auto to have around 58 cents per share. That's a forward PE of 40. And I personally believe that Li Auto is going to have a much higher EPS than 58. My estimations are closer to around 90 cents, making that forward PE much lower than what analysts expect. This now is for T-Doc, and again it's the same thing, whereas analysts expect around 325 and therefore forward PE of 66. My estimations are closer to T-Doc doing between $5 to $9 per share, and therefore the forward PE in my estimations are much lower, and I can see the stock as reasonably valued. So seeing these high forward PEs, high price to sales ratio, shouldn't automatically put you off a stock, but you should have done enough research to be confident that they're actually going to surpass whatever these analysts have estimated, and therefore the stock is actually undervalued. But if you're actually just expecting them to meet these analyst estimates, then you can't really be buying stocks that have a forward PE for 5 years from now of 70, 80, 90, 100. Because what kind of PE are you expecting the company to have 5 years from now for you to be able to double your money? So it's just a way that I think you guys should be looking at stocks that you're considering investing in or are holding at a time when the market is kind of resetting valuations like this. Maybe this doesn't continue and maybe we go back to the craziness of the market just going up every single day. But if we don't, if interest rates do come, if inflation does come, I think it's best to be prepared and know that even if you apply a conservative PE ratio to your stocks and you say 5 years from now they should be priced at 40 or 50 times earnings, and that would still double my money, instead of investing in companies where you say I have to apply 120 PE ratio for me to justifiably think that they can double my money. So don't dismiss stocks automatically just because analysts say they're too highly valued, just because analyst estimates are this low. So any analyst will tell me that T-Rock is highly overvalued, it's only going to earn 3 cents per share, but I disagree. I think it's going to earn between 5 to 9 cents per share. I think Li Auto will earn around $1 per share. So in scenarios such as that, when you're confident, don't be dissuaded by analysts, but just be careful and say, okay, 5 years from now, can I reasonably expect the company to double my money based on a conservative and fair PE without me having to kind of put a huge premium on it? Because if you're relying on having to put a huge premium on it, you're relying on investor sentiment, you're relying on there being a bubblish atmosphere in the market, you're relying that people's moods is what's going to take your stock returns up rather than the stock's fundamentals itself. So Guys, I know this was a bit of a deep one, but I hope you found it useful. I hope you enjoyed it. If you did, as always, all I ask is that you smash that like button. And if you're not already, then please do hit subscribe if you enjoy these kind of analyses and you gained any kind of insight from it. But until next time, do take care, and I hope to speak to you all again soon.